What I'd like to talk to you today about is traditional premium financing versus a new program that we're coming out with or that we're releasing today. I guess this is a unique opportunity because whoever's on this is going to hear this for the first time ever. Our leveraged life program is what we're calling it. I know the advertisement said hyper funding. That's not really what we're doing. This is a materially different program than maybe the old hyperfunding or some hyperfunding that people have been familiar with. So without further ado, let's get right into it. Because we're sort of putting this out to the public and not everybody's familiar with our company, I'm going to take a quick second to introduce ourselves. Advisors Resource Company. We're founded by a former chief actuary, and it was really born out of the realization that advisors and insurance professionals are asked to do everything. They're asked to generate proposals, work on case design, handle service, take paperwork, etc. And so that's what we were born out of, the frustration of doing that stuff. And so we've been created, our company at least has been created to help with those things. We have over 100 years of combined experience in the home office, regional offices, and even agent roles. And finally, our core values, as you can see on the screen. What we do is our premier producer process. You can see that laid out pretty straight up here. So, and some of you have seen that. If you haven't seen this, we're reaching out to you anyways to try to set up a follow-up to share more. So don't worry. And I went through that a little fast because, again, I want to get right into the main event, and that is traditional financing versus our new program we call the Leverage Life program. So, what we're going to talk about today is, well, a non-leveraged policy. What does that look like? So, that's where we're going to start off is what does a non-leveraged policy look like? So, we have a baseline. What does a traditional finance policy look like? What does the Leverage Life policy look like? The Leverage Life program look like? And then what are some considerations and benefits? So without further ado, we are assuming a 40-year-old standard 60,000 for 10 years. That's what we're going to put into all of these programs. So we're going to put the same amount into each one, and we're going to back into some numbers for the finance version, but you'll see here in a second. So I'm only showing you this non-leveraged one to have a baseline for comparison because we need a baseline for comparison. I mean, I don't know how you'd get past that if you don't. So let's go right into it. 60,000 again, 10 years on a 40-year-old. We're doing income at 66 to 100. As you can see, the income's going to be roughly 177,322. I suppose if you have any questions about this, go ahead and ask it. But again, this is just a baseline to get our bearings. Like this is what we're competing against. This is the bar. The financing has to overperform this in order for it to be worth it. So that's where we're at. So if you just did a straight up index policy, put it 60,000 in it for 10 years, and then started taking loans for income beginning at age 66 and going on to age 100, this is exactly what it would look like. So I don't think I have any questions there. Pretty straightforward. Now, traditional financing. So a couple of assumptions here. I got to make some interest rate assumptions. I'm using some declining interest rate assumptions, but let's first go into what is traditional financing. So the first step, and I've got all these flow charts and whatnot, but the first step is the client's going to establish the policy, and they establish the policy, and they're going to borrow from the bank the premiums. Now, in this circumstances, they're going to be servicing the loan, and we calculated the annualized premiums into the policy to be to where 60,000 amortized is paying interest only, basically. So frankly, this is pretty leveraged, this projection. So we're doing an out of pocket or a client contribution of 60,000 paying back to the bank. And then the premiums are going to be just over 200,000. So generally how this works is client gets the policy, the bank puts the premiums in, client pays back the bank out of pocket for the years that we're in the accumulation phase. We use the policy as collateral. In this circumstance, for the first 4 or 5 years, the client is actually going to have to post collateral in excess of their life policy. So that's an important consideration when we compare our leverage life program. So the next slide, client eventually will use the accumulated cash value to quote unquote take out the bank, to pay off the bank. It's pretty typical design. I like to look at it at 10 years to pay off the bank. I think it's reasonable. There's some people that will take it out 15 years plus. I don't frankly like that design. I like the 10-year design, but does it really matter? The purpose of this conversation is just to compare something. So it's kind of our idea here. But basically, the accumulated cash value is going to be used to pay off the bank loan. In this case, the bank loan at the end of 10 years is going to be exactly equivalent to 10 times the annualized premium of the policy, or the max funded premium, which in this case is $207,131. So this is just a ledger of this whole arrangement. And again, we have bank loans 207. That's actually the premium that's going in. So the 207 is going right into the policy. The client is making interest payments of 60,000. At the end of the 10 years, the loan balance is equivalent to 10 times of the payment. And again, that's because we've amortized this to pay interest only effectively. Now, the loan rate that I'm assuming a decreasing loan. I don't know what loan rates are going to be. A little above 7 is sort of generally the market. I mean, it all depends. So this is an estimation at this point, but I'm assuming 7.3 decreasing for 10 years, and then paying that off with the policy, with a policy loan in this year. You can see that happening in year 11 where we're paying off the loan. So the surrender value goes down, the loan balance goes away from right here, and they go about their merry way. Now, here's the number that you need to keep in mind. Well, first off, before I continue, 1 second. The downside with this, which we're going to cover in a minute, this column over here is the deficit between the loan balance and the surrender value of the policy. The client is going to have to put up cash in excess of 86,000 in the first year. That declines over time, but the first year they have to put in at least 86,000, declining to 74, 59, 39, 18. And then it's zero beyond year 6. So just something to keep in mind. We're assuming that they're going to have to contribute or post collateral in this arrangement, which again adds to the risk, because in theory they could lose more than the 60,000 that they put in. They could in theory lose up to all of it. So anyways, next slide. This is the income beginning at age 66. It's cut off here, but it actually goes to age 100. So there's a big benefit, right? You put up the same 60 grand instead of only 177,000. I'm going to get it 305,000. Not bad. Not bad, right? I mean, that's not a bad deal. So that's the benefit to the leverage. Now, our program, the Leverage Life program. This is, you might call this personal finance. You might call it I don't know, private financing, but we're calling it the Leverage Life program, and I'm about to show you how it works. I think this de-risk is the whole transaction, allows the client to potentially change their mind. I mean, I think this is a huge opportunity. So, step one. This is how it works. The client's going to put 60,000 into the first policy. So initially we set up one policy. It's an IUL policy. We fund that for 10 years. It's going to be fun from age 40 to 50. Beginning in policy year number 3, we start taking a policy loan from the first policy to pay the premiums on the second policy. So we're going to do a $60,000 loan into policy B. And conceptually, we're going to make the 10 payments into this. And then we're going to take loans from policy A to policy B, make 10 payments from that into policy B via the policy loans. So bear with me. After the policy B has been established for 3 years, we're going to do another policy C, where you're taking the loans from policy B to pay the premiums on policy C. Now, that is a simplistic view of it. We have a program to balance these loans so that not one policy becomes in danger of lapsing or becoming overloaned, etc. But in essence, we pool these 3 policies together, and that is how we determine where the loans need to come from and so forth. So this is like the simple way to think about it, but this is what we're doing. And I had that all written out in text. So you take out the first policy. After 3 years, you're taking the policy from policy A to pay policy B, and then the same thing through policy C. So what is the aggregated effect of this? What happens here? So number one, if I do policy A and 3 years later, market conditions have changed, I can't put up the money, whatever, I can always change my mind and not do policy B. Don't have to do that policy at that point. It gives me an out so that if I'm worried about the market conditions, I'm not stuck. Whereas if I do a full-blown financing arrangement, you're stuck. You signed the thing. You've got this $5 million policy where you're putting in 200,000 and you've already borrowed against it. You got a big problem if you change your mind. Whereas in this, I've got a lot of flexibility. And I'm going to recap these benefits. And I think I'm going to run over 15 minutes, so I apologize. But so this is the aggregated ledger. You know, we want to balance these policies so that you're not overloading one, but here's like the 3 policies together. So you'll notice after the 3 years, the death benefit goes up dramatically. After the next 3 years, the cash value the death benefit goes up dramatically. This is the aggregation of the 3 policies together. And this is the important consideration from this. So you can see the 60,000 out of pocket for the first 3 years. That's going straight to the first policy. Then you have 60,000 continuing to be paid. The total premium's 120,000, but I'm taking a $60,000 loan to pay for part of that premium, and then so forth. So you can see how that kind of ticks down. Now, number one, this is not nearly as much leverage as the premium financing ledger. So you could, in theory, leverage this up a little bit more, but listen, I want to be realistic. I don't want to skinny it down to the last dollar. So what is the outcome of this? What's the income? So you go from 177,000 of income with no additional out of pocket. Our income ends up being 242,000. Let's just call it 243,000. 243,000. Now that's fantastic. We increased it by 50% basically. Well, a little less than 50%, but we've increased it by over 70,000. That's a dramatic difference for no additional out of pocket. Not only that, but also the client retains a death benefit that's quite substantial over the life of these contracts, especially because they're aggregated. It only ends up going down to maybe about this 1.8 million, and then it kind of comes back up. So it's a pretty big benefit. So pretty powerful stuff here. And the underlying benefit is you have total control over this. So, in summary, do the IUL, do a traditional IUL, you get 177,000 of income. Do the traditional financing, 305. You do the leverage life program, 242,000. Now, there's some major considerations that you need to take, and I'm mainly speaking comparing the premium financing versus the leverage life program, but major considerations that you need to make here. And the first one being traditional financing, it's going to require a bank loan, generally subject to rate changes. I mean, you would not lock in your rate today, so you're going to be open to rate changes. You're going to have collateral requirements. If you change your mind, you're going to lose money. Like, there's no doubt in my mind, you will lose money if you decide you can't make those payments and you need to do something different. There's just no way around it. It's very inflexible traditional financing. Uh, well, and not only that, but also you have to qualify for the loan. So, because it requires a bank loan. And you may lose more than what you actually contributed because of that collateral requirement. You got to post nearly 90,000 in the first year. And if you change your mind, you're going to have a problem. Significantly more risk, not to mention you don't know where rates are going to be in the future. So, the benefits of the Leverage Life program. I've sort of alluded to this, and maybe this is a good time to pause for a second and see if any questions roll in. But the main thing is flexibility. We can be completely dynamic with this program in that after 3 years, you know what? I don't want to take the risk to finance. Okay, no problem. Just do a regular. This is just a regular IUL. We don't even have to make any changes. You just keep paying the premiums. You know what? I don't quite have 60,000 anymore to put up for this plan. Well, that's fine. We can drop the premium down. No big deal. You know, it's not going to look as good as it did originally, but it's really materially no big deal. The risk factor is mitigated dramatically by that flexibility. So you're not necessarily like locked in to continue the financing over this next 10 years. You don't have this big death benefit that you need to cover or pay for to allow for those big premiums. You decide not to do it, you change your mind, no big deal. Not only that, no collateral requirements. And if you do traditional financing, generally there's some programs out there that don't require collateral, whatever, but generally you're going to have to post some type of collateral. And then finally, one of the biggest benefits is you don't have to go through the hassle of qualifying financially for the bank loan. You don't have to send in your returns. You don't have to do any of that. You just do the first policy, and then we use the features that are available to you in the next 3 years. So, needless to say, I think this overcomes a lot of the typical risks from that type of from a financing arrangement. So I got a question. This is actually a really good question, and I'm going to stop here because I didn't address this in the beginning. It says, what if my health declines from plan A to B or from policy C to B? What if it changes? How do they qualify under this program? So the first thing is we use a company. or we would recommend a company that we work with that, number one, provides a discount when we bundle the term and an IUL together. So we would typically establish a convertible term based on the projected future face value that we would need on policy B and policy C. Um, so we would do a projection based on the future insurance need. And what I would recommend is that by policy three, we can convert that. That's fine. But we would also want to maybe look at the market real quick and see if there's any other options that we should consider. So to answer your question, um, yeah, that's how we would address that. I got another question that says, we'd like to see the illustrations and historical information. Yeah, I'd be happy to go over that with you. We can definitely do that. I don't have it in this presentation, but that's no problem. Let's see. Yeah. All right, cool. Be happy to visit with you about that. So that's no problem. Fantastic. Well, we're real excited about this program, and I think I think it allows a lot of flexibility for clients. It one additional. Oh, I got another question. So are you buying all the policies up front? No, you're buying one IUL in year one, and then 3 years later you'll convert if you did the term conversion. So you'd buy one IUL in the first year, and then later on we would convert those. Um, I got another question. Oh, I'm getting a couple. Hold on a sec. Okay, so buying all policies up front. No, you're just buying a term. Someone asked if we have an app to illustrate this strategy. We can illustrate it we have some presentation software that we can illustrate it for you. Um, so someone asked about adjusting payments. So my intention there was, or my what I meant by that was if you established a regular IUL and then after a couple of years change your mind on how much you wanted to put in or you needed to put in less, um, then you could adjust that and then just not do policy B and C. Because what you would not want to do is you would not want to um, get into a situation where you're in a financing situation and your funding changes, because then you'll end up with this large death benefit with all the expenses and so forth. So if you decided to change or stop payment after the first or second year, we would just need to address it in the context of that one policy, not as if you had done those other policies. So that's what I mean by it gives you a lot of flexibility and ability to change your mind or do something different. So I hope that answers the questions. Um, let's see. What kind of minimum fundings are recommended? It's a good question. I mean, you could do it as small as 20,000 a year. That really comes down to your appetite of working with a client. I would try to do 20,000 or more would be my recommendation. I'm not here. I'm going to put up my email address. Someone asked a question I don't quite understand, so maybe email me your contact information. I'd be happy to reach out to talk in more detail. I'm not sure I understand the question. So they're asking anonymously, so I don't think I understand the question. So feel free to shoot me an email or give me a call after this, and I'll hopefully I can answer it. But this is our contact information here, and I'm going to stick around for a little bit longer. I can definitely answer any additional questions. but we do have uh, presentation for this. We're happy to illustrate it and kind of go from there. So, um, oh, okay, I get okay. So the question was, what if you become uninsurable after the first year? And our strategy is to buy one IUL, pair that with a term to protect the insurability. So the term would be like in this example, 2 million, the IUL is 1 million. So after 3 years, you would convert part of that term to establish policy B. 3 years after that, you would convert the rest of the term to establish policy C. So that's kind of the strategy there. So I hope that answers the question. Awesome. Great. Well, I'm like I said, I'll stay on here for a little bit longer. Um, but thanks everybody for joining you. We'll be reaching out after this meeting. What we'd like to do is definitely, if you aren't appointed with us or working with us, we'd love to learn about your business, see how we can work together, and share more about the strategy. If you are working with us, we'd love to run some proposals for you and offer this solution to your client. I think it could be a huge opportunity. One thing to also consider is if you do have clients who have been in an IUL for a number of years, this could be a way to increase their potential income. So it doesn't necessarily have to be in a policy that was originally written new today. It could be a IUL that was a little bit older, and we can leverage it that way. So there's a lot of different ways to leverage this and make it work. Great. Thanks, everybody. And yeah, if you, like I said, we'll be reaching out and we'll set up meetings to go over what we're doing for advisors. And if you work with us already, then we'll be happy to talk about this more and go from there. Just got a question. Beneficial to use an older policy with more cash in it? Yeah, potentially. It all depends on the loan features. So that would be something that we would help you do a due diligence on and verify. Because if you have an old IUL with no spread, I've seen certain carriers that have a low cap and then a high loan rate. Well, that's not going to work for this. There's not enough juice in there. So the answer is maybe. I mean, it all depends. Excellent. Well, thanks everybody. Like I said, we'll be reaching out and kind of go from there. For the person that asked about that, I'll reach out to you and we can talk and go from there. Great. Thanks everybody. I'll be following up soon, and my team will be following up soon. Daniel, Brendan, and myself. Thanks everybody.